Hello everyone, it is Sterling here from Trading Forex Live. It's April 22nd, 2014, and regardless of the time that you're listening to this video, whether it's the day after or whether it's 5 years from now, what we're going to talk about here is the absolute central core of what we do. It's the core behind what made Day Trading Forex Live so successful. We started out as a live room. What that means is that every single trade we took was live, and it was live for years over the course of hundreds of trades. And so what we're going to talk about here isn't some pretty, idea on a chart or some thought that sounds good in theory but doesn't work out. It's time tested, not just a week, not a month, not even a year, but literally years. We traded this for over the course of those years, hundreds of trades live in front of everybody in the room. So the core of that, what we taught and what we did live, is exactly what I want to talk about here today. And quite frankly, I think it is the absolute most important foundational reason behind our belief. And I think it is, if somebody really understands it, it's absolutely game-changing information. So we'll get right into it here. And I want to start with a question. I want you to analyze the strategy you're using right now, and really probably any strategy you have ever used. And I want you to ask yourself, what is required for the market to produce a buy signal? Does the market, is your strategy designed to produce a buy signal in a falling market? Well, no. Your strategy, and I think this is pretty common, your strategy is designed to produce a buy signal in a rising market. Now, maybe that's on a first pullback in a rising market. Maybe it's a second push up. Maybe again it's another pullback. It eventually will trigger that buy signal somewhere after the first initial move. So the first initial move occurs, begins to start pointing things to the upside, and somewhere along that move your strategy is designed to produce a buy signal. Now every strategy is going to be different, but the general point I'm trying to get across is your strategy is designed to produce a buy signal in that rising market. Now conversely, if we look at the opposite side to that, we look at a falling market. What is your strategy designed to do in a falling market? Well, your strategy, again, at some point in a falling market, after the market has began to fall, it's designed to produce a sell signal somewhere along the way, somewhere in this point after the first initial move has initiated itself. So another way of saying that is that any strategy you've used and you're probably currently using is reactive. It first relies on a action in the market. Now the action of the market may be rising or falling, but the action of the market, and here's the key, the action of the market produces your reaction. So why is that put you in an extremely vulnerable position? Well, that wouldn't be a vulnerable position if there was not a controlling force in the market. And the great lie that this market can't be manipulated keeps people in that, again, that vulnerable state where they feel like there's not that controlling force. But what do the numbers tell us? This is a number that I want you to look up. Don't trust me. Don't trust anything I say. Prove it to yourself. Go to Google, type in Forex, click on the first Wikipedia link, and scroll down to the market breakdown of the 10 largest traders by volume. You'll see it starts with Deutsche Bank controlling roughly 15%. And you'll see if you add up the first five, based on the last time I looked at it, the first five banks control a little over 57% of the daily volume. Now let's put this in perspective. Volume is volume. So percentage is percentage, whether you're dealing with a $10,000 a day market or a $10 trillion a day market. The bottom line is a percentage is a percentage. A majority percentage is a majority percentage regardless of the size of the market. So to put this in perspective, if you knew the trader that controlled 58%, let's round it up, 58% of a certain stock, let's say Google, if there was a trader that controlled 58% of the daily volume, and you knew when that trader was buying, when they were selling, what positions they were holding, and when they were likely to, again, move one way or the other in the market, first, would that information benefit you? Hands down, that information would benefit you. I think everybody's obviously answering that with a resounding yes. Now the flip side to that, which is equally as important, is do you think it would be a deficit if you took the opposite side to that trader? If you were selling when he was buying, if you were shorting that stock when he was buying, or if you were buying when he was shorting that stock, moving a major position at that time. Well, the answer to that is obviously, again, it would be a major detriment. It's a pretty clear answer. Now, that one person, although they control the majority, they may not be able to control that stock long term. In other words, they may not be able to control what that does over the course of 6 months. But at the very least, they could control short term market direction if they had the majority share. So let's apply those same rules to the Forex market. Again, 5 banks control 58% of the daily volume. So while overall market direction for the course of months or years will not be dictated long term with a plan that starts 1 year and ends up 3 years later, a 3 year long term plan, while that may not be what's occurring, that really doesn't matter to us. What matters to us is what occurs on a daily basis, because that's how most of us trade. So if you're trading off of a chart hourly or smaller, and even larger charts, we can see this manipulation in them, but we address mainly the smaller term charts. When you think about that point, they can control short-term market direction. So why does that put you in a very vulnerable position? Well, again, we just discussed that the action of the market creates the reaction from you. Do you think I'm the only one that understands that? Well, I can assure you that I'm not the only one that understands that, and I can assure you that smart money also understands that if they have the desire to buy, they need to find selling pressure. They are going to induce a falling market, which is going to create or allow your reaction of selling into that falling market. Again, the action of the market creates the reaction from the trader, and that selling pressure is what they buy into. Conversely, if they have the desire to sell the market, they will at first induce the buying pressure. How do they do that? They allow or create a rising market. The action of the rising market creates your reaction of buying into that rising market. As you buy into that rising market, all along the way, smart money is selling into that rising market, eventually knowing that they're going to turn and overpower the market at the desired point. So the bottom line here is that controlling force understands how to create selling pressure when they want to buy, and they understand how to create buying pressure when they want to sell. So if you're trading based off of a reactive strategy, in other words, a strategy that we talked about in the beginning, a strategy that identifies a rising market as the way it using a rising market to buy into the market, or using that as a signal to buy into the market. And conversely, if your strategy uses a falling market to eventually signal a sell, then you're trading a reactive based strategy. Now, that reactive based strategy, again, is very dangerous because it puts you at the mercy of smart money. It puts you at the mercy of the controlling force, and you don't know when that move is likely to continue or when it's likely to stop and reverse. The bottom line is you're trading with the hope that that market is going to continue. And oftentimes, because reactive based strategies do not catch the first part of the move, you're trading off of the center part of the move, which produces a much larger stop because you're not going to get your stop beyond the overall low. So what is the difference with a predictive based strategy or predictive trading? Well, I'm going to illustrate that point with a trade we took in the room here today. Now, this was a pre-selected level, 38.21. This is the level that I selected right back here during the Asian session. This is the Asian session back here. And I pre-select levels during the Asian session. And so as I pre-selected that 38.21 level, that is essentially what is our possible high probability point, an area of liquidity where we might see the manipulation. And during the New York session, at the beginning of the New York session, which is the 8 to 11:30 a.m. time that this gray box blocks out, the market came into that upper manipulation point. This is during our room here today, our live room. And the market broke through that point, validated a confirming entry. I'm not going to go through how I pick manipulation points or the confirming entry because there's a lot of information on the site if you really want to go into that, or if you want to dig into it deeper. That would make this a 30-minute video if I get into all that. So you can go check that out on the site if you like. But the bottom line is it was a pre-selected level. It validated our specific entry criteria, and the trade was taken. Why is that so powerful? Well, our entry here was on this pullback candle, and our entry was at 17 in the room. Now, that was we pretty much picked the top on this pullback, you're not always going to do that, but here's the point. It was about 7.5 pips from the high. That allowed us to use roughly a 12 pip stop. So the power behind a 12 pip stop is gigantic when you're looking at a potential target profit of 40 pips. That's putting you in a situation where you're looking for a 3.3 to 1 risk reward on that trade initially. Now you may not end up with that ultimately, and I didn't in this case, but the point behind that is you're going into the trade with a risk reward that's extremely high. A risk reward to where you could win 20% of the time and still be above break even. So you're in a very powerful position trading that predictive strategy. The reason being is you're trading the start of that move. You're not waiting for the market to fall to eventually trigger your strategy to sell into the falling market, which is what reactive strategies do. You're predictively pre-selecting a level based on the criteria we use, waiting for the market to get into that level and validate the trade based on the criteria that we use, and taking the trade from the start of the move. Now, are you going to win every trade? Of course not. We take losing trades just like anybody else, and I try to say that in every single video. I never want to seem one-sided because that's definitely not the case. Hands down, we get it wrong, and there's no doubt about that. The power behind what we do is the fact that when you have correctly identified an entry point of smart money, you know you're in for a move that is not just going to be on average. You're not just going to see a 20, 30, 40 pip move. You're often going to see a much larger move. Now, in this market, we're dealing with 30, 40 pip ranges. So the bottom line is we're dealing with extremely stagnant moves. And the point that I'm getting at here is that when you have correctly identified an entry by smart money, you're going to see the larger moves of the day. Now, maybe that's going to be a smaller move based on the type of market you're in. But in a normal market, you're often in for a move that's going to be 70, 80, 90 pips in an average daily range, in a range that is average over the course of years, which tends to be on the euro around 120, 130 pips over the course of years. So right now we're dealing with an extremely stagnant market, but the bottom line is you're often in for the largest move of the day after that manipulation or after some manipulation occurs, which may be multi-directional on any one given day. It's not a coincidence here that today, why did the market aggressively break below the lows, confirm back to the upside before giving this move to the upside? It's not a coincidence that this false break of a major low occurred. As it induces that selling pressure, people are selling into that market. And there was technically, which is a little more complicated, I don't necessarily want to get into it too much. Even if you would have been short from this point, it's a good signal that smart money is buying into the selling pressure after you see this big stop run of the lows. So the bottom line is that this manipulation occurs frequently. It occurs on often a daily basis. I only look at 2 pairs, so I do deal with a much smaller window, but it occurs on all pairs and it occurs on all time frames. I prefer to take trades off the 15-minute chart, and that's what we teach. But the difference between a reactive strategy and a predictive strategy is very distinct. If you're looking at the market and you're asking yourself, why does it seem like I get stopped out immediately after I enter a trade? I see the trend. It produces everything that my strategy calls for. It's given me everything I want. It's got a strong start to the move, and then I enter the trade long, and then the market automatically falls on me. Or I enter the trade short, and the market, shoots to the upside. The bottom line is when you're trading a reactive based strategy, and really think about what your strategy is, because if it's reactive, then the question you should be asking yourself before every trade is, how do I know this isn't smart money inducing selling pressure or inducing buying pressure? Because if you don't know that, and you don't know that with a very high degree of certainty, then you're fighting the controlling force of the market. It's not my belief that they're the controlling force. It's the facts based on the numbers. And because of that, we really have 2 choices. We either identify the best way to track the controlling force of this market, or we blindly take entries, never having any idea what the controlling force of this market is. To me, the only logical way to trade is to say, okay, these are the people that control the market. How do they control the market? What is their only vulnerability? Their only vulnerability is the fact that they need selling pressure when they want to buy, and they need buying pressure when they want to sell. Now, for most traders that never give that any thought, that's not necessarily their vulnerability, because it's often what provides them the fuel. They induce the buying pressure, they allow the rising market. Everybody gets trapped into a long, and they're the ones selling into the buying pressure. They snap the price back, everybody gets stopped out. If you can identify that stop run, though, that's a massively important chunk of information. You've just identified where smart money is selling into the market. What do you think is going to happen if the controlling forces are selling? The market's going down. And that's what allows us to predictively trade versus reactive trading. Really think about all the strategies you've used, all the strategies that you are currently using. If they're reactive, every trade you take, you should be asking yourself, how do I know this isn't smart money inducing the buying pressure to sell into it, or inducing the selling pressure to buy it right back up? That's the question to ask. And if you want to get into predictive trading, feel free to check out the site daytradingforexlive.com. Ton of information on the site, ton of videos, ton of articles that walk through it. And as always, Chad and I are happy to answer any emails that you guys may have. So feel free to shoot that over to us. If you do, daytradingforexlive@gmail.com, and we'll be happy to get back with you. So I hope you enjoyed the video, guys. I hope it was at the very least informative, and I look forward to talking with you next time. Until then, happy trading.